A couple of weeks ago, I made a video stating that no one can predict the market. No one knows whether a stock is going to go up or down the next day. You don't know whether that next candlestick is going to be green or red. No one can predict this sort of thing because in efficient markets, markets are random, right? And I know that's tough for some people to grasp. I know a lot of people disagree with this because a lot of people want to believe that their technical analysis or their fundamental analysis can accurately and reliably predict the markets, but this just isn't the case. And the reason this isn't the case is because of the efficient market theory. So what is efficient market theory? Well, the efficient market theory states that the price of any financial asset, such as a stock, right, a stock's share price, for example, that its price reflects all the information available. Meaning all the information that's out there, be it through news, technical analysis, the fundamentals of the company, all that information's already been factored into that stock's price, right? So if there's any piece of information out there that you can find, other people can also find it, it's already been factored into the price, right? There's no bit of research that you can go do that somebody else doesn't also have that same access to that same information. Thus, you're not going to find some bit of information out there that hasn't already been baked into that company's share price. So if you're a trader or an investor, should you be able to outperform the market on a consistent basis? Well, if you believe in efficient market theory, no, you shouldn't be able to go and pick stocks and consistently and repeatedly year after year, decade after decade, outperform the overall stock market because you have access to the same information that everybody else does. What makes you so special at picking stocks, right? Well, nothing, right? I mean, could you get lucky? Sure. People do outperform the market, and some people do outperform the market for a number of years or even decades. But does that necessarily mean they're a great trader? Or does that mean that there was, some degree of luck involved? Who knows? But one of the real keys to efficient market theory that if you're a trader, you need to understand, because so many traders don't understand this point. And when we're talking about efficient market theory, we're typically talking about news. Any kind of news that comes out, especially unexpected news, right? When we're talking about news that comes out about a company, many traders will go and find this story or this rumor on the internet or on social media about a particular stock that they want to trade, and then they'll trade based off of that news, thinking they just discovered something that no one else has found out about yet, right? And in many cases, no. By the time you find it, other people have already found it, and unless you were the very first person to find that bit of information, somebody else has already found it, already reported on it. Information has spread, especially to the large players in the trading game. You're talking about your hedge funds and things like that, the big institutional players, and they've already acted on that information. And chances are that stock price, right, that stock's share price already reflects whatever news you just came across. You think it's just hot off the presses and you're the very first person to find that? No. In most cases, you're already way too late to that game. Most of you guys have probably heard the old saying, buy the rumor, sell the news. Now, what buy the rumor, sell the news means is typically you buy a stock on the rumor, on the, before the news actually hits, and, maybe something will happen in the future. Just people are whispering about stuff. But when the news actually is official, that's when you sell, right? That's when you get out of that position. And very few people time these things right. By the time there's actually news articles about something, do not go in it all gung-ho and bullish, because that is actually the sell the news portion of that. You should have bought on the rumor before it became actual news. And again, this is just something to consider, because most of the time, when you're a new trader, you get this completely wrong, right? By the time the news stories and news articles, by the time something's exploding in price, think of all the meme stocks, the meme stock craze with GameStop and AMC, a few years ago, or now the AI craze with Nvidia and AMD, and people are just jumping on the bandwagon, but it's already probably too late in these cases, because already whatever the news about AI is going to be the next wave of the future, right? This has been in the news for at least 2 years now, right? So if you're just now jumping on that bandwagon now, you have already missed that boat. That boat is already sailed. One of the things that really moves stocks around is was truly unexpected news. So that's news that comes out that was completely unknown to anybody at the time. So, for example, the death of a CEO, or a CEO gets into legal trouble, whatever it happens to be, something really strange and unexpected happens right then and there, right? And it's a big story, and that's when, a stock can have huge swings up or down, in whatever direction it tends to go on, whether it's good news or bad news. But whatever it is, it was unexpected. Nobody really knew that event was even a possibility. And these kinds of unexpected, unknown bits of news, these are not unusual events. Like, these things happen all the time, where all of a sudden, some crazy news story about a company will come out and the stock will, explode in price, up 20% in a day or down 20% in a day. And this is the reason that you can't predict the market. This is the reason your technical indicators and your technical analysis, they don't work. It's because you can't predict that kind of unknown, unexpected event. Your technical indicator can't take that into account. That's not, technical indicators, all they look at past price action and past volume. They can't reliably predict what possible news will come out tomorrow. That's not, that's just not even a possibility with those things. Because of efficient market theory, and because markets are random, right? This is the reason that you'll find many traders and investors, they consider market strategies to be just wishful thinking, right? Like, they're not real things. Like, you really can't plan ahead for the future. Whatever strategy that you devise, you're devising this market strategy based on current information, current known information. But again, there's so much potential future unknown information that's going to occur. You can't really predict anything. So whatever market strategy you have, at the end, it's all just kind of guesswork. Maybe it works out for you, maybe it won't. And today's markets are so much more efficient than even markets 20 years ago, because the stock market has become extremely efficient, mainly due to technology. So the way this works is that prices, they adjust their share price based on information as it comes out, right? Whether it be, the fundamentals of the company or news events, whatever it happens to be. Every time some new piece of information comes out, the price of that stock adjusts accordingly based on how people trade that stock, based on the information that individual investors are receiving, right? And with the advent of the internet, we get this kind of information so much quicker because of the advent of the internet and mobile devices, and especially sharing information through social media. We get this information almost instantly now. And that's why our markets are so efficient that you cannot possibly game the system. There's no edge to be had through things like technical analysis or fundamental analysis. And really, because of the internet and social media, it's almost gotten to the point that, as far as, efficient market theory is all about all publicly known information that we have on a company, well, there's almost nothing that you can't find now because of social media, because of the internet. There's very little insider information that, is not something that you don't have access to publicly anymore. I mean, there's still insider information. There's still such a thing as insider trading, which are those insiders of a company trading based on, knowledge that they have of the company that is not widely known to the public. Now, that's very, very illegal. Now, you go to prison for that. And the reason you go to prison for that is because if efficient market theory holds and there's no real edge to be had as long as everybody has the same publicly available information, well, those that break the rules by trading off of information that is not available to the rest of us, right, they should be punished, right? They should go to jail for that. So the efficient market theory comes in three different flavors. There's really not just one efficient market theory. There's actually three of them. The first one is called weak form efficiency. So you can think of weak form efficiency as the entry level into efficient market theory. I think most traders will understand weak form efficiency, and most will agree with it. And basically what weak form efficiency states is that the price of all financial assets is already taking into account all the past price action, all the past volume action. And because of that, technical analysis is complete and total BS. That's essentially weak form theory, right? It's basically saying that your share price of ABC stock, right, it's already taken into account everything that stock has done in the past. And because technical analysis, all it does is look at past price action and volume, right? It's completely pointless. It's completely worthless. Technical analysis just doesn't work. Weak form essentially is the general financial disclaimer that so many mutual funds and other trading institutions often tell traders and investors. And that disclaimer, of course, is past performance is no guarantee of future results, right? That essentially sums up weak form efficiency. Whatever a stock did in the past, there's no guarantee it's going to do that same thing into the future. In other words, future prices can't be predicted merely by looking at past prices. It just doesn't work that way. The second type of efficient market theory is called semi-strong form theory. Now, what is semi-strong? Well, it's a theory that follows the belief that neither technical analysis nor fundamental analysis can help you in predicting the markets. Semi-strong theory basically says that all information, all the technical information, so everything based on past price action and volume, as well as all the fundamentals of the company, all the news events, and everything that's out there as far as technical and fundamental metrics, it's already baked into that share price. Because of that, once again, there's nothing you can do with technical analysis nor fundamental analysis to accurately and reliably predict where that stock is going into the future. And finally, the third form of efficient market theory is called the strong form efficiency. And strong form efficiency, as the name implies, is the strongest of these forms, because this hypothesis states that all information about a stock is known and it's already been baked into the share price. And by all information, I mean all information, whether it's publicly available information that you and me can go get, or whether it's private, unknown information, insider information about a company. Somehow that information also magically escapes and it gets factored into these prices too. There's no information out there that's going to help you in determining where a stock is going into the future. And that, again, the price of all these stocks, right? It's efficient, right? All the information's already been baked into that price. So you going and analyzing information, analyzing things like technical analysis and fundamental analysis is completely pointless. And obviously with the strong form efficient theory here, what this states is because all information has already been baked into a stock price, there's no such thing as insider trading if you believe in strong form efficiency, because the information that the insiders have, that too has also been factored into that price, whether they know it or not. And there's no advantage for them, even if they know in advance, for example, what the earnings of a company, you know what your company's going to report for earnings, say the next day, well before the public will get that information, right? Can you accurately and reliably trade off of it? No. And the reason you can't trade off of it, well, the main reason you can't trade off of it is because you have no idea how the market will react to that news. Even if you know, hey, we're going to report really good earnings or really bad earnings. Well, how's the public going to react to that? You never know. Many companies report really good earnings and then see their stock price fall as a reaction, or they report really bad earnings and see their stock price go up. And the reason is because the stock market doesn't move based on whether you reported good earnings or not. It moves based on how many buyers and sellers of that stock trade that stock on that day. And because of that, again, efficient market theory, no one can reliably predict the market. Markets are random. Technical analysis, fundamental analysis, if you want to use them, fine. But just know this, you're never going to gain an edge using that sort of stuff. And I know that's a really unfortunate truth. And I know it makes a lot of traders uncomfortable, especially traders on video platforms like YouTube and TikTok, who, 95% of the videos that I see on YouTube and TikTok are people promoting their favorite technical indicator. And it just doesn't work. Peace, guys.